the Federal Reserve Bank of San Francisco recently released a fairly startling prediction. And it's pretty simple, but I'll explain why, at least to me, it was startling. And they said that the excess pandemic savings that you and I were able to put aside during the first 18 months of the pandemic because of stimulus payments, and frankly, because we weren't able to do as many things, those excess savings are going to be depleted by the end of 2023. And so why is that startling to me? It's startling to me because life is getting more expensive, right? Food's more expensive, gas is more expensive, rent's up almost 20%. I buy used cars. I've been hit hard. The price of used cars have almost gone up by 50% since the start of the pandemic, right? So how have Americans been paying for that? Because we know wages haven't been keeping up with inflation. I think a lot of us have been paying for that by dipping into these reserves that we were able to build up during the first 18 months of the pandemic. And you know, the numbers are startling as far as reserves outside of this pandemic savings. So 2/3 of Americans do not have an emergency fund. And what I mean by that is at least 3 months of living expenses set aside, right? So that's not, you know, too surprising. I think we know that. Also, almost 50% of Americans could not come up with $1,000 if they needed that, you know, their car had an expensive repair that they needed, or, you know, God forbid somebody got hurt and had to go to the emergency room. So there's not much of a buffer area for Americans, and that pandemic savings is, I think, how many people were able to deal with the increased cost. But, you know, the title of this video is, you know, when's it going to happen? You know, when's it eventually going to happen? What I mean by that is, you know, are we going to hit a recession? And is it going to also impact the stock market? So I want to talk about that, but first we have to talk about a few facts, right? It's not just here in the US, right? One of the most important economies in the world, obviously, is the US and Europe and other economies, the Japanese economy. But you know, more and more, the Chinese economy becomes important to the entire world. And China is going through a tough time right now. 80% of their average population, 80%, I should say, 80% of the net worth of the average Chinese person is tied up in real estate. And, you know, that's been a bubble in the making for years. Everybody has said this cannot continue. And, you know, it's always amazing how long things that cannot continue do continue. But it does look like the shine has come off of the Chinese real estate, and it's time to pay the piper. Earlier recently, Evergrande, which is one of the largest real estate developers in China, filed for bankruptcy, and that's having a ripple down effect. And a lot of the Chinese people that own real estate, their house is not even complete yet, but yet in China, you start paying your mortgage when you sign the contract to say, okay, I want that apartment, I'm going to buy it now. Here in the US, we usually put down earnest money, and we don't start paying our mortgage, we don't start making house payments until we can move in. But in China, it's different. And given how prevalent the average Chinese citizen's accounts are with real estate, that could be a big problem. So that's one issue. And then coming back at home, you know, I think we've all seen it, right? Since 2020, rents are up almost 20%. The cost of food's up significantly. Energy's up significantly. What else do I have? Used cars is up over 40%. Cereal and grain, just the grain itself. Forget about the cereal that we have for breakfast. The raw food supply is up 30%. I've mentioned before, my box of Raisin Bran, I happen to like Raisin Bran, went from $3 before the pandemic to almost $7. And you know what? I switched to the off-brand, and it's just as good. And I'm probably not going back, right? And I'm not the only American that's doing that. So the question is, you know, is there going to be a recession? Are we in a recession now? And is it going to impact the stock market? And if so, you know, what does that mean to you? And what should you be doing? So let's take these one at a time. You know, are we in a recession? Technically, no. There is a definition of a recession that a lot of people use. But really, there's several factors, not just GDP, which is usually what people use, 2/4 of negative GDP growth. But you know what? Our unemployment has held up, and we haven't had a lot of people being laid off. We're starting to see more of that. But our unemployment rates are still historically very, very low, and that's been helping us out. But you know, I think that can also cloud the issue. And the issue is, you know, maybe we're having what I call a rolling recession, where there's some areas of our economy that are in a recession now, right? I mean, a lot of these big tech companies that did very well during the pandemic, now they're facing layoffs. And so I think that area, if we just looked at that industry, that sector is in a recession. And I think there's other categories that are also in a recession. And you know, maybe that's what a soft landing is. Maybe if there's a rolling recession, that's fine, but I suspect that's not the case, right? I suspect more than not what we're seeing is a lag from when the Federal Reserve raises interest rates, and you know, this is the most rapid outside of the 1980s increase of interest rates in our country's history. So we've gotten a lot of interest rate increases in a very short period of time. I mean, 2 years ago, people were getting sub 3% mortgages. And as I record this, you know, mortgage rates are just a tad below 7.4%. And a lot of smart people are saying they're going up to 8%, right? So there's a lag effect because, you know, it doesn't impact a lot of us day one. If you've already got your mortgage, the increase in mortgage rates is not impacting you. If you don't have a credit, if you don't carry a balance on your credit card, it's not impacting you. Yes, the higher costs are impacting you, but the higher cost of debt takes a while to trickle down through the economy, right? Because a lot of the companies that we buy goods and services from, they loaded up on debt at the beginning of the pandemic or shortly after the pandemic when interest rates just, you know, plummeted. And they wanted to get as much debt as they could to weather this storm because they didn't know how long it was going to last. And so fortunately, they haven't had to refinance. But you know what? The day is coming when they are going to have to refinance. And then their cost of money is going to go up, and they're going to pass that on to you and I. So, you know, has the economy slowed already? Yes, absolutely. There's no doubt about that. Are we in a recession? I don't think we are yet, but I think we're in a rolling recession, which may not necessarily be a bad thing for us. So, and what about the stock market? You know, given that, should you be worried about the stock market and should you get out now, right? I mean, for a lot of us, it seems like, well, of course, if you think the stock market is going to go down, you want to get out before that happens. But the question you have to ask yourself is maybe it's already priced in. You know, there have been many people that have been hurt because they think a recession is coming. They think a crash is coming. And the vast, vast majority of people, this is not financial advice. I want you to work with your own financial advisor, but the vast majority of us are much better off to come up with an asset allocation, how much in stocks and how much in bonds, and stick with that over time. So I hope this video has been helpful. I also want you to look at this video over here that talks about, you know, how to invest your money in a dividend portfolio as you approach retirement, because I think for a lot of folks, that's something that you want on your radar screen to at least consider. So be sure to watch this video here that talks about dividend investing. Take care. Thanks for watching. Bye-bye.